What is a cost curve in commodity production costs? Imagine trying to figure out which farmers or factories can produce a crop or metal at the lowest cost. That's where a cost curve in commodity production costs comes into play. It's a simple graph that shows how much it costs to make a commodity depending on how much you produce. The graph lines up all producers from the cheapest to the most expensive to produce. The horizontal line shows the total amount made, while the vertical line shows the cost per unit. As you produce more, the curve usually goes upward because higher cost producers need to be involved to meet demand. This curve helps investors and traders understand who can stay profitable at different prices. The price of a commodity is often set near the cost of the last producer needed to supply the market, called the marginal producer. If the market price is below that producer's cost, they might stop producing, reducing supply. If the price is higher, more producers can make a profit, encouraging more supply. When demand increases, prices tend to rise to cover the higher costs of some producers. When demand drops, prices fall, and only the lowest cost producers stay in business. Knowing the cost curve helps investors see which producers are likely to survive if prices go up or down. It also shows how changes in input costs, like fuel or labor, can shift the entire curve. If input costs go down, the curve shifts downward, meaning production becomes cheaper. If technology improves, costs can drop too, making it easier for producers to stay profitable. Key terms include cash cost, which is the direct expense to produce one unit, not counting taxes or capital costs. Marginal cost is the expense of making one more unit. Economies of scale happen when producing more lowers the average cost, while diseconomies of scale mean costs go up as production increases. In short, a cost curve is a visual tool that shows how much it costs to produce a commodity at different levels of output. It helps investors understand which producers can stay profitable and how market prices are influenced by the costs of all suppliers. This understanding is vital for making smart investment choices in commodity markets.